Hi everyone, welcome back to another episode of The Lens. This week we only have our host Larry McDonald, but guess who's joining us? The Dr. Robert Van Battenberg. We're so happy to have you here this week. We apologize for missing last week, but we had some stuff going on. The team was in New York. We had a great presentation at the University Club. We had great appearances, CNBC, Fox. You can look them up in our website at thebirdshopsreport.com. And if you're interested in, any commentary mentioned all throughout this video, you can email us at info@thebirdshopsreport.com. Today, we're going to discuss what we've been seeing last week, what we saw today, and especially what happened last night. So, Larry, Rob, you ready? Take the stage.
Thank you, Valentina. And, once again, I'm really want to thank everyone. We had an incredible week in New York. We did a nice, Rob and I did a nice presentation at the University Club, and we had ideas dinners. We're going to share some of the intelligence today from that. Also, our book, How to Listen to Market Speak, top 3, 4, 5 all week on Amazon. Special thanks to Squawk Box. They had us on CNBC and Fox's Charles Payne. We had a really good week in New York. Rob, I wanted to bring you in today because, your background, I think, on the street in energy, you worked on the Morse team, I think at Citi, but over the years, the institutional clients that I, have the most respect for really trust you around energy. What stands out? Where's the trade? Right now, there's 27 trillion in the NASDAQ 100. $27 trillion of wealth. The energy names are a little bit more than 2 trillion. And one of the points we make in the book, energy, natural gas, copper, the entire infrastructure for artificial intelligence is basically very, very underowned. You wrote a report. Wow, it was just an incredible report early April on the independent power producers, on uranium. Let's look at oil today. Let's look at the Middle East. But, special thanks to you, Rob, for that report that you wrote on the independent power producers, the NUKZ, all of those names. They're all up like 50, 60% since April. Thanks very much, Rob.
Well, that's where, to us, the most of the action is because of the insatiable demand for AI. And the need for the United States to expand on its power capacity, which it hasn't done for a very long time. So where do you go? You're going to conventional, you're going to alternatives as well. I quite frankly do not know how that ultimately ends up in the reconciliation bill, which is now in the Senate. They have to mark it up, and they will have to eventually pass it. It contains a lot of tax cuts, but it also contains some provisions to dial back some of the subsidies and support for alternative energy that were in the Inflation Reduction Act from Joe Biden. So the Senate apparently is pulling back some of those cutbacks because solar, of course, is an important part of the equation. And so is natural gas, and so is nuclear becoming an important part of that equation. But we saw this week Oracle ramping up its capex on data centers, right? They're spending now 37% they're going to spend 37% of revenues on
37% of revenues.
Yes, and this was a company that up until recently was very light on capex. Right, Apple and Oracle were generally very light on capex. Right, only like 2 years ago they had 8 billion of capex annually. Now they're moving that up to 25 billion, and they say they still have to send people away, customers away, because they just can't meet the demand. And as Oracle increases that capex, other companies have to follow. And I think one important reason why they ramp up that capex is that they want to soak up all the available equipment and infrastructure to take it away from some of these startups, right? So they want to suck the start. They want to prevent startups and private companies that do not have that unencumbered access to capital. They want to prevent them from becoming more viable competitors. So that's essentially the battle that is taking place there. And we've seen that in the marketplace.
Yeah.
You've seen that with with the utilities like NRJ. We see that with Vistra. We see that with GE Vernova, and you see.
Yeah, and those were all in your model portfolio that you laid out in April, and it's just fantastic job, and anybody that wants that report, it's such a key report right now for artificial intelligence. Info at thebeartrapsreport.com. Rob, so this week, let's go through the energy side. So huge week, tragedy in the Middle East again. One thing clients have been pointing out to me is that you see here energy once again on a double bottom low versus tech. So once again, 27 trillion in the Nasdaq 100, only about 2 trillion, a little bit more in energy. Nobody really owns the energy space. So you're coming into a period of time where you've got the election next year. It's almost like Trump wants as much pain away from the election as possible in terms of energy, right? So in other words, the people in the chat thinks that the White House blessed this attack. The bottom line is we're a long way from the midterms, so we could have seasonally. I think June is the best month for oil. We laid that out to clients. We could have a little runway here for some energy. What are you trying to say in this chart here?
We've seen this movie before. We've seen Israel's been attacking Iran quite regularly since 2023. I mean, it goes back to 2011. I mean, even if you go further back, but just highlighting where what happened to the S&P, and like on the timeline of the S&P, basically showing you where the attacks were, and eventually what happened to the market. The market generally shrugs them off. Now, there's been an interesting dynamic, which is that growth stocks and cyclicals such as energy have generally been quite strongly correlated. The argument is, of course, that it's on the one hand you have a market that's either going risk off or risk on. When the market is risk off, they basically rotate into defenses such as healthcare, staples, and utilities. And when it's risk on, they generally rotate into growth stocks, but also into cyclicals. And one can make the argument that it's the growth stocks right now that have the best hope to drive as much growth into the economy, to sort of support and even let some of the commodity demand grow.
Yeah, well, that's why everyone owns them. It's 27 trillion in the Nasdaq 100, right? So everybody's long that trade, right?
Yes, of course. Well, the table here shows you also what happens when
what are you trying to say
you
here?
have the attacks, right? The days of the attack. The first one was, of course, with the United States took out that Soleimani, that Iranian general, in the beginning of 2020. On Iraqi soil, actually. So oil jumped 3% the first day, but a month later it was down. Now, of course, COVID started also to play a role there. But generally, these kind of attacks, oil needs to, in order for oil to actually have a sustained recovery, it needs to grow organically. These attacks generally do not do that trick. One can make the case either way, whether this is structurally long for oil. That's a very hard case to make. Whether this could actually usher in a period of oil rally because oil is.
But Rob, we're told the economy is so strong. Jobs. We're lectured every day about the strength of the U.S. economy. So you would think that would be relatively supportive of.
Well, whether the economy is strong or not. Oil demand and gasoline demand has sort of been struggling, right, to grow, even in the United States, and more importantly, in China, where the economy is not that strong, or in Europe, where the economy is not that strong. The bigger question is why is oil demand or gasoline demand in the United States sort of flatlining, or even just struggling to see any growth? Even at an economy that's still growing nominally 5%, is that because of EVs, hybrids, or better gas mileage, or people driving less, or all of the above? We don't really know. But I think that is.
And what are you trying to say here, Rob, with WTI versus Brent?
Well, Brent versus WTI, is a sign of geopolitical risk. WTI, even though it's now exportable and it's being exported to other countries, it's generally priced inland in Cushing. Well, that is where it's priced, and Brent is priced in the global markets. So if the spread between the two widens, that is a sign of geopolitical risk. Of course, Brent is very, very, very much influenced by the oil that's coming from the Middle East, whereas WTI is very much a domestic, right? Canada feeds into it, the United States. So if that spread widens, that is a sign that people are getting nervous about supply risks from the Middle East or Russia for that matter. So
And this and these lows here, that's wider, right? Is that you're trying to say that that's a Brent premium to WTI?
yes. Yeah.
Okay.
So in general, like people watch that as a sign of geopolitical risk. There's not no massive spike yet. We've seen a significant move in the Brent contango backwardation. We have that chart coming in a couple of slides later, but that shows that people are bidding up the front month relative to the outer months. So in a situation like
So
this,
I think
where you have,
I think well, I just want to make a quick comment on the slide. So the way I would trade the way I would execute a trade on oil here is look at you got a bullish MACD. You can see that weekly MACD is important. Historically, when you have that kind of fast rate of change, the MACD, where you've got that lower line moving kind of violently up, that's a sign of basically a cycle shift. And as you can see there historically, a lot of times when you have that bullish weekly MACD, you have a trade that may not last, for months on end, but there's a trade there. Now, the way I would trade oil here is you've got a buy signal here. You buy the pullback. Any pullback today, oil's already I think 6% off the high today. Oh my God! So and I think you stop yourself out, somewhere below that red line. But you're playing for kind of, as you can see there, that bullish MACD reversal. Historically, that can get you a 1 or 2 month rally. Seasonally, June's the best month for oil. We're coming into the summer driving season, and we know the election, the midterms are way out there in November of 2026. So does Trump really want to manipulate oil down now? No, I think he wants to. And we said this a couple of weeks ago. We said this literally 2 weeks ago on the show. We've been bullish oil, and we think you want to kind of play this at least for a couple of months. What are you trying to say here, Rob? Backwardation.
So generally, when you have a spike in Middle East risk or geopolitical risk in general that affects oil supplies, then the front month contract spikes relative to the futures. So that the spread between the front month or the spot oil goes up relative to the futures. That's what you're seeing here.
So let me just walk people through that. So people want to buy are you looking, is this 1 versus 2 months right
Yes.
here?
I think it's 1
Okay,
versus
so
6 months, to be honest.
Okay, so in other words, people, when the momentum shifts more positively, or people have to they want to own the front month, because it's like, why do they want to own the front month versus the 6? And what does that tell you about the market right now?
Well, the front month represents the physical market. So if people are worried about like supply disruptions, they want to have physical barrels, and they're going to obviously take them off the market or secure them or somehow take control of these physical barrels, and that is represented in the spot price. Whereas people realize that this is only like a short-term event, so the futures market not really moves. So when you look at oil versus oil stocks, you see that very much. Like oil stocks are up 1%, and the front month oil future is up like 6-7%. And that's what you see, because oil stocks, especially U.S. stocks, not Saudi Aramco, but U.S. stocks or European oil stocks, they are very much capture the price over a longer period of time. They sell futures, they embark on longer term contracts, and they are all locked in based on where 6-month futures or 12-month futures are. So they get an average price, whereas oil itself and the oil ETF, the USO, essentially captures the front month, right? So that's why the USO drastically outperforms the oil stocks in a period of like a big and sudden flare up in Middle Eastern risk. Now, Israeli military officials are saying that this could last for up to 2 weeks. I don't know. It could be. But having said that, so
yeah, there aren't many off ramps for the next week or two. I mean, Trump can say whatever he wants to say in terms of trying to do a deal, but I don't see any off ramp for at least a week or two. And I find it interesting that, see, the XLF is, the financials have been dramatically outperforming this very crowded trade. We're seeing some clients short the financials versus going long energy. But you can see here, even before today, this chart's a couple days old. Even before today, you had a pretty nice reversal there coming out of a deep capitulation. XLE energy stocks versus XLF financials. So that's a shift going on there too. And this we put up earlier. This is the XLE versus technology. So we're seeing a big reversal in a very under-owned sector. Once again, 27 trillion in the Nasdaq 100, only little bit more than 2 trillion in energy. Energy is a tiny percentage of the S&P, and we're in a more multipolar world. We make that point in the book, a bestseller here, How to Listen to Markets Speak, around global conflicts. You need a whole new portfolio construction, and what's working. All the themes in the book: uranium, nuclear power, natural gas. That energy infrastructure theme that's all part of the book around artificial intelligence. It's really playing out. We're really proud of that. And Rob, the job that you did in the book is fantastic. Next slide. What's next for the slides here? So what we've been doing, Rob, is, to your point, there have been buy signals and sell signals in energy. We put out trade alerts via WhatsApp, but we've been just trading the range because we're not in an oil bull market. We've very consistently been buying kind of those capitulation moments the last couple of years, selling the rallies, because we've just been totally range bound in energy, as you laid out there. This might have some legs, so I'm not going to sell this rally right away because I just like the seasonal setup. But you want to be careful if you're long energy with the USO, and that's just an ETF in the oil space. We just use ETFs to show how people might trade the space. Most clients of ours trade oil futures. Rob, the one thing we've been doing here is on the commodity side, we talk about this in the book: platinum, palladium, silver. Rob, I think one thing I want to shift gears, because you're the author of our new report, Washington Pressure Points. We've noticed that there's a big broadening out from gold to silver to platinum. There's a lot of reasons for that. We've been buying platinum. We have a whole section of the book on platinum. But Rob, talk about Basent and the bag of tricks. In other words, everyone's bearish about bonds in the third, fourth quarter. Everyone knows that this potential Liz Truss moment, this bond panic that Dalio's talking about, that Paul Tudor Jones is talking about, that everybody, I mean, there's a lot of people talking about a bond crash. And Basent has this bag of tricks. To me, that bag of tricks looks a lot like financial repression.
Hey, gents, we have some questions from the chat if you would like to answer them.
Sure.
First one is, does the USD and crude correlate?
Does the US dollar and crude correlate? There are times when it does, and there are times when it doesn't. We've had a very weak dollar of late, and we've had relatively weak oil. Typically, a weak dollar should be very supportive of oil. One of the things we talked about in the book is, if you go into a deep bear market for oil, for the dollar, if you go to a deep bear market for the dollar, and a secular bear market for the dollar, that's very supportive of commodities. We've seen that with gold. We've seen that somewhat with copper. That has not been supportive of oil. But is Rob there?
Yeah.
So Rob, this whole multipolar world around financial repression. So in other words, Basent, we've got the debt ceiling coming up. We have a budget battle. And once that battle is completed, then they're going to raise the debt ceiling by what's the number, 4 trillion. And then there's what's the ratio? I'm sorry, what's the total amount of new bonds that'll be for sale later in the year?
Right. Yeah. So, this morning it was interesting that it was an article saying that the Senate GOP hardliners are now melting away and starting to throw their support behind the bill. I don't know if that is really true altogether, but there's been some holdouts like Senator Johnson and that are right now coming into the fold, and that could help passage. And I think that that's also explains why yields are grinding higher now. Right, earlier in the day they were low, risk off environment, and now suddenly they're
Well, yields should be higher with oil. I mean, right?
Yeah,
I mean,
but if you break down the rise of yields, right, you look at real yields and you look at it break evens or inflation swaps. And then when oil spikes like this, then yields go higher, and it's driven by inflation swaps, then okay, the yields are higher because of inflation fears. But the inflation swaps are not really moving that much. It's the real yields that are moving more. And the real yields are a reflection of expectations of economic growth, real growth. So the real yields are moving, and I suspect they're moving on that, right? Also,
well, we have a chart, CPI versus Bloomberg Commodities, and so think of this week, Rob. My question for you: everybody was focused on CPI and inflation. There was a big celebration. I mean, enormous celebration all across Wall Street about the calm CPI number. And what I've found over the last couple of years is whenever we've had a surprise in the commodity space, like oil's a large chunk of BCOM. Whenever we have that kind of move, kind of a violent move in commodities, whether it be oil, then you get a bounce in CPI. So I find it interesting that we've had 3 very calm, very Goldilocks type CPI readings. So my point is that this week's CPI reading that a lot of people are celebrating about is relatively meaningless if we're in an oil reversal that's going to bounce for a couple of weeks.
right? Yeah, we'll have to see. To me, that remain. Yeah, I don't know. Like Trump, does he want oil prices higher or lower? I suspect.
Oh, he wants them lower, but into the midterms for sure. Yeah, I don't think he cares right now. He says he
Right.
cares on the air. He doesn't care now. He just, if
Well,
you're Trump and you've been impeached twice, the only thing you want is to have as much low oil pressure points for next year. You want to save all your powder for next year, right?
yeah, perhaps, but you're also dealing with Besant, who has to pump $1.6 trillion of
Yeah. So let's get back in that. I asked that earlier. So because let's wrap it up for the audience. This is really important. So total bond issuance, once they raise the debt ceiling, it's going to be concentrated in the later part of the year. It's 1.5 trillion, which potentially is 600 billion more than last year.
Right. Yeah. So there's a wall of paper coming to the market, and how are they going to finance that? Same thing happened in 2023, and Janet Yellen had to dump $1.7 trillion of paper on the market in a period between June and October, and yields backed up 140 basis points. It went from 3.5, it went all the way up to 5%. And generally, when yields go up, the market doesn't really care. Actually, they kind of like it. You see that there's multiple expansion with a higher rising yield environment. I know
Right.
that goes against the market doctrine, but it's true. Since
Well, true,
1997.
Rob. But I would just counter. One of the things clients are talking about, since yields have backed up over the last several months, it's interesting that high yield and especially commercial real estate, look at for the last couple of months, 4, 5, 6 months, 9 months, commercial real estate spreads have been coming down. In other words, yields lower. Now we've got that back up. So what I'm hearing is higher for longer. Yeah, there's some parts of the market that don't care. Higher for longer is not great for commercial real estate. As you can see here, from 2000, looking from 2015 to 2019, 20, there was a ton of loans that were structured anywhere between, like, as you can see there, 1.5% to 2.5%. So those loans are sitting on bank balance sheets or out there. Now, some of them have been termed out, but there's a lot of them that are down 50 cents in the dollar, 40 cents in the dollar, 60 cents in the dollar. There's some real pain out there. There's commercial real estate buildings that just are not, the economics of financing them isn't there. So I would just, I would look at the interest rate backup as there are winners and losers, right?
Yeah, so that's why Trump and Bessent are obsessed with bringing the long bond down. They're obsessed with it. It's one of their the primary motivators is to bring long bonds down, and they're trying everything possible to make that happen, or at least not have them go back to 5 or maybe 5.5%. So back in 2023, Janet Yellen had like excess capital outside of the liquidity system that you could tap into that to sell their bills to. And
so she got so Rob, the TGA was down to 46 billion. So it's the Treasury general account. All that means is that's the Treasury's checking account. So it went from like 700 to 46, and then she had to refill it. Explain why that's important for the viewers.
Well, the budget deficit is going to be 700 to 800 billion for the rest of the year, and the year ends in the end of September. And then you have the extraordinary items that Bessent has been using to create room under the debt ceiling. He has to refill those. So that's another 350 billion. And then he has to also replenish the savings account that he has with cash that he's been using to pay the government bills. And that's down now to 277 billion. The data came out last night.
And what's the extent? Well, when do they run out of cash right now? Because they're draining all these cash sources. Because right now there's no new debt issuance, right? We're at the debt ceiling.
So there's no new debt issuance. There's some room becoming available by the end of this month. So the X date is probably around August. And so they have until August to figure this out, but then they have to sign that legislation. They have no room to negotiate beyond that. So they're trying to iron it right now out, and they'll probably be happy when they pass that legislation. But the negative then for the market is how does the market absorb this wall of treasuries that are coming as the debt ceiling increases? And I think this is one of the biggest known unknowns out there. Will yields back up the way they did when Yellen had to do the same thing 2 years ago? Will Secretary Bessent, together with Powell, have enough absorption capacity with all these tools in their toolkit to absorb this wall of money? The Fed can stop QT. The Fed can remove the supplemental leverage ratio. The Fed can do.
So hold on, but Rob, we need to simplify this for the audience, right? So all that means is the SLR. The Fed can kind of force through regulation the banks to own more treasuries, right? And one of the things that clients talked about this week, that's the SLR. And that's financial repression. If you're forcing banks, think of this week, Ted Cruz floats this idea, Rob. I mean, we got to bring it full circle. He floats this idea to get rid of interest on excess reserves. Now, I'm not saying that's going to happen, but he's essentially putting a gun on the table. That's $1 trillion a year. Is that annual for the banks? It's $1 trillion, right? Of interest. So right now the banks get this interest on excess reserve. Ted Cruz at a private meeting on the Hill talks about taking this away from the banks. I think this was done on purpose because he kind of wants to put the gun on the table and say to the banks, listen, you guys are going to be buying a lot of treasury bonds in the third, fourth quarter, and don't give me a hard time. I think that's the messaging here. What do you think?
Oh yeah, 100%. Well, I don't know. I mean, Ted Cruz is a smart guy. I don't know how well read he is on the plumbing, on the financial system. He's saying that it costs the taxpayer basically more than $1 trillion a year to give money for free to the banking system in the United States and abroad. He says half of those payments are actually made to banks abroad, right? Because they get money the banks get money to keep this excess reserve parked at the Fed. And they get now 1.1 trillion. It used to be much smaller amount, like 400 billion. But because Fed funds rates are high now, the interest on excess reserves rate follows the Fed funds rate. So when they were at the lower bound of zero, the banks earned almost nothing. Now they earn 1.1 trillion. It's an annual transfer of money from the US taxpayer to the biggest banks in the world. And he's saying, if we're fighting over $50 billion here or there, Doge took so much effort to find $175 billion of fraud, abuse, and waste in the government. 175 billion they're fighting over, and here we give 1.1 trillion dollars to the banks every year. For what? Nobody knows.
But this is why. But let's bring it back. How are we going to make money, right? Let's just not lecture people on academics. How are we going to?
No, well, I mean,
but what I mean is, what I see is this week, this whole SLR, all this toolkit. They know they have a bond shit show in the third, fourth quarter. When Gunlack's telling you that, Paul Tudor Jones, Dralio, everyone's telling us that. Everyone knows this is coming. So if they use the toolkit to kind of suppress yields and use the bank balance sheets, which is the same as using, that's financial repression. And guess what? The commodity trade from gold is broadening out to silver, broadening out to platinum. And Bitcoin, I find it very interesting that this whole financial repression toolkit that they're pulling out here and the threats from Ted Cruz on the, like you said, interest on excess reserves. This to me is setting up for that multipolar move in the world back toward commodities where you've got a higher interest rate regime. They got to hold rates down either with QE or they've got to do something because interest on the debt is $1 trillion a year. And if they don't get rates down, that's a big problem. Trump said that. But any other questions, Valentina?
Yes, we do. We have some more questions from the audience. The next one is, Japan is the largest foreign holder of U.S. Treasuries. When JGB yields spike, Japanese investors rotate capital back home, dumping U.S. Treasuries. U.S. Treasury yields rise. What do you think?
Yeah, Rob, this is a good one for you. So go through this. The bank, if there's pressure on Japan bonds at the same time as U.S. bonds.
Yeah, well, the reason why Japan and China have such enormous reserves is because they run massive account surpluses with the US. And if they allow the currency to go to above certain levels, they would lose their competitive advantage. So what they do is they sterilize the capital inflows, right? From if you sell a Toyota to the United States, you get like $40,000, and that goes from the US to Japan. So what do they do with these dollars? If they would sell those dollars, they would convert them in yen. The yen will go up, the dollar would go down. And if they do that enough and enough and enough, right? China runs a $450 billion surplus with the United States every single year. So the Chinese currency would go up and they would become non-competitive. So they don't want to do that. So they built these massive reserves of dollars. Right. That they basically can go in 2 or 3 things. They have to go into dollar-denominated assets. They can go into gold, they go into into U.S. treasuries, or they can go in treasury-like vehicles that are just as safe, like, for example, agency mortgage-backed securities and what have you not. So they're not going to rotate into Japanese bonds if the JGB yields spike relative to treasuries. They don't. Because they would have to convert back into yen. The yen would go up. Their economy would go to the recession. That's not the worry. Now, for global investors, yeah, there may be a case to be made to go more deeper into Japanese bonds than into U.S. treasuries. But a lot of the global investors have dollars. They have to do something with those dollars. They can't just necessarily go into other currencies. So this is a play of global dollar liquidity. And basically, this ties back also to what will happen when they do raise the debt ceiling, right? With liquidity, with dollar liquidity. Right now, dollar liquidity has sort of remained stable because the US government is not issuing more debt, right? It's 36.2 trillion. It has been at this level since January of this year. But now they raised the debt ceiling and they 4 to 5 trillion of extra debt room is going to be. So we need more dollars all of a sudden. We need 4 to 5 trillion more dollars because somebody's got to buy that debt and they need dollars to buy it. So suddenly you have a massive increase in liquidity. Now, you as a gold bug would say that's great for gold because that's just fiat currency debasement. As a stock investor, one would say, oh, this is great for stocks because the liquidity has to go somewhere. It will go to stocks too. Bitcoin aficionados would say this is great for Bitcoin because all that liquidity in dollars is going to find their way into Bitcoin because Bitcoin is also an asset that's primarily bought to prevent fiat currency debasement or to protect against fiat currency debasement. So it's going to be a bonanza of all these financial assets, whether precious metals, of course, Bitcoin, stocks. Yes, that's the dollar liquidity that is coming to you pretty soon.
Well, you know what, guys? I've got to go to. We're gonna do a hit with Fox. We're gonna air it tonight. Rob, I want you to have a great weekend. That beautiful daughter of yours. How old's your little one now, Rob?
Almost 3. Her birthday is next week.
Awesome, awesome. And Valentina, you look absolutely beautiful. Thank you for everything. And Jose, the entire team in New York, Cole, everyone, we had a great week. Let's see you next week. Rob, thanks for joining us this week. And everyone, thank you. Everyone, have a great weekend. And I'm going to be watching the U.S. Open this afternoon. Looking forward to it. All right, guys. Thanks.
Bye-bye.
Bye-bye.
Thank you so much for joining us. As you saw today, we're accepting live questions all throughout the video. We can either put them on screen, I can read them off, but we'll be looking into that. So make sure you make your questions all throughout this video. Remember, guys, we have a New York Times best-selling book, which is How to Listen When Markets Speak. This week, we were in the top 10, and we really want to thank you because this is all because of you. Also, remember, we host an institutional live chat on Bloomberg with more than 660 investors in around maybe 30 countries. We have around 150 contributors, and we're growing our company by the minute. We also have a Discord live chat, which is pretty similar to the Bloomberg, where it's a perfect alternative for the retail investor. If you're interested in this, in the Discord, in the Bloomberg, we also have a new product, as Larry mentioned this in this video, Washington Pressure Points, drafted by the one and only Robert Van Mattenberg. So if you're interested in any of these, you can reach me at info@theredshopsreport.com, and I'll be happy to give you all the information that you need. Thank you, Jose. Thank you, Rob. Thank you, Larry, and we'll see you next week. Bye.